Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, another week of massive volatility. Fed officials focused on bringing down inflation as the prospect of weaker growth bites into credit. We begin with the big issue, whipsawed by treasuries.
You're starting to see this reversal.
We've seen this week, finally, bonds behaving as a safe haven.
The stock-bond correlation is starting to fall apart.
I'm not going to get too excited with a 4-day trend.
I don't think they're coming to save us. They've got to hike.
Is it a soft landing? Is it a recession? Is it stagflation?
You're entering into a very challenging growth inflation mix. Where I think inflation is sticky, growth is decelerating.
On the credit side, you also get some liquidity concerns.
All of these really huge headwinds for bonds.
It's an evolution from an inflation interest rate concern to a growth and credit concern.
We've seen this extraordinary run-up in bond yields.
There comes a point where they're increasingly attractive in an outright sense.
At least they deserve to be discussed again.
Joining us now to discuss Morgan Stanley's Sankaran, Jim Bianco of Bianco Research, and Meghan Graper of Barclays. Meghan, first to you. Is the inverse correlation between bonds and risk assets, is it back?
Well, I think what's for certain is that the narrative is visibly changed. I mean, we've got a reasonably uneven picture emerging across asset classes. I think a bit of a capitulation trade playing out over the second half of this week, but you've got a VIX that's approaching year-to-date highs. You've got global stocks that are at 18-month lows, and you've got rates, while off the peak, still anywhere from 130 to 185 basis points higher on the year. The U.S. dollars returned to the safe haven play. So I think all signs are pointing to evidence of a financial tightening. And I think with that as the backdrop, as encouraged as the markets have been by the fact that we've begun to see break-even inflations coming down, I think it's also left investors shifting focus to the next potential landmines. And the question becomes, if we're past peak inflation, do we need to start worrying now about the global growth landscape?
Meghan, do you think we do? Are we there? Is that the next shoe to drop?
I personally think, it's a bit early to call. It's a bit premature to make, we're not entirely out of the woods. But I do think the focus is now towards global growth. And, how restrictive we need to be will ultimately be a function of how tolerant the Fed is willing to be as they evaluate the impact of more restrictive pace of policy on the growth, the global growth picture. And they'll be in good company with central banks around the globe beginning to accelerate their pace of policy tightening. Some have been well anticipated, the BOE, Norway. I think others, if you look at India or Australia, have been real surprises to the upside.
Jim, that's exactly what this has felt like. We've gone from inflation shock to rate shock, and now it looks like the start of a growth shock, a growth scare, kind of bleeding through this market. Would that be your take as well, Jim?
I'm not quite there just yet. If you look back to the Fed meeting, in the 6 days following the Fed meeting, the S&P was down 10%, the NASDAQ was down 13% in 6 days. I think what you saw with the bond market was a reaction to the speed of the decline, not necessarily how low we've gone. And the tell will be, with this rebound that we've got going in risk assets, do bond yields just go back above 3% and on their way towards 320 again? The answer is no, we're not there yet. If they stay down here, then yes, we are going to then start to consider growth. But I also mentioned that Jay Powell spoke last night on Marketplace Radio.
Yeah.
And boy, did he say some pretty hawkish things. He put 75 back on the table. He basically said he's not paying attention to this. My interpretation, he's not paying attention to growth. It's all about inflation. And he called the demand for labor out of whack. That sounds like, get ready. He's going to keep hiking and hiking and hiking. And if the stock market's on its knees begging for him to stop, I don't think he's going to listen right away.
Sankaran, I went through the transcript yesterday evening. I assume Jim did as well. Perhaps he listened to it. Here's one of the quotes from it. I will also say that the process of getting inflation down to 2% will also include some pain. But ultimately, the most painful thing would be if we were to fail to deal with it and inflation were to get entrenched. It feels like this pain we're seing in the market is a desired outcome. It is a feature, it is not a bug. And Sri, I'd go further. If you take the words from Fed President Mary Daly to us yesterday, I think that's probably the most interesting Fed speak of the entire week. Mary Daly said this: I expect financial conditions to tighten even more as we march through these rate increases and remove stimulus from the economy. I would like to see continued tightening of financial conditions. Sri, for a market participant, you hear a Fed official say that. Aren't they just telling you exactly what they want to happen with markets through the rest of this summer?
Yeah, I mean, totally agree with that, right? So I think there was the debate earlier on in the year whether the trade-off between inflation and growth, how much of a balance they would be able to achieve, et cetera. I think right now it's very clear which side of the mandate they are leaning on. And the path to getting to, I mean, I think the soft landing headline debate, I think it'll be only with the benefit of hindsight that we'll be able to determine that. But the path from where inflation is now to a more kind of acceptable level will involve at least more growth scares being priced into the market, and specifically within credit. Because up until this point in time, I mean, at least the first quarter price action was almost around, well, it's the more in the rate sensitive pockets, the more duration sensitive pockets, which are underperforming within credit. I think now we're getting into the stage where it is going to be the credit intensive, growth sensitive pockets which start to see more of the pain.
Sri, you thought about getting ahead of that a number of weeks ago. I remember reading the note. Coming into this year was very much about loans over high yield, say. Has that changed for you now?
Absolutely. So I think for us, towards the back half of April, as when we made that shift, it was very clear that at this point in time, we're looking at risk reward. Where are you getting paid to take on risk? And where is the credit market mispricing some of the growth outlook ahead? I mean, it was very clear that the loan market was going to be a technical beneficiary initially, but incrementally, this is about the fundamentals of how higher interest rates feed through into the corporate's affordability of debt and sustainability of debt. And that effectively means that the loan market's ability to outperform is going to be challenged. And we've already seen that play out in the last couple of weeks.
Meghan, we're starting to see this in spreads as well. Let's go to your world. What are you seeing that you think we should pay a little bit more attention to?
Yeah, I mean, we saw another week of outperformance in IG credit. So as much as it was a disruptive week in other asset classes, you saw high yield and loans continuing to materially underperform. I mean, high yield was back another 39 basis points wider. Euro IG hit another new wide last week as well. But the U.S. credit index at 131 basis points. I mean, IG cash has still not returned to the mid-March wides, in large part due to the rate moves we've seen over the course of the year. So I think if we think about the direction forward, IG spreads are already pricing in a significant amount of risk. I think, that's relative to supply demand technicals that are still very much intact, but it's also related to the strength of corporate fundamentals. So if you talk to our strategists at Barclays, I think, our updated spread forecasts are calling for no more than another 15 or 20 basis points of incremental widening from here in IG. That compares to, another 50 to 75 basis points of widening in high yield as we approach year end. But I think elevated volatility should mean or should be a negative for spreads. But I think lighter supply, I think demand that, while cautious, is still playing in the barbells, and the strength of the fundamentals are all going to be insulatory factors here for the foreseeable future.
Jim Bianco, your take, please.
Yeah, I think that credit is definitely going to rotate into being the thing to watch, because while Mary Daly said that tightening financial conditions, I'm going to interpret that as meaning that they're fine with the stock market selling off. But if we get to the point where we start to see credit widen a lot more, that's what really concerns them. We're not at that point yet, but credit has been moving quite wider real fast over the last several days.
Michael Harnett over at Bank of America puts out a great weekly note on a Friday. I'm sure some of you read it. And there's always these lines that jump off the page. Here's one. Markets stop panicking when policymakers start panicking. We all know that line. But policy panic is inflation. That's Wall Street negative. So, Sri, as we start to think about what would scare the Fed, if we can use those words, what would it be with that in mind, with the words of Michael Harnett in mind?
The way I would think about it is that obviously there is a lot of discussion around where the Fed foot is with respect to the credit markets and so on. I mean, it feels like we're quite some distance away from that. I mean, for the point that Meghan made earlier on the whole investment grade spreads, where they are versus, I would use the the late 2018, early 2019 correction as the reference level. We're probably around 10 to 15 basis points off those. That's going to be the first starting point. But even so, the other thing that the Fed's going to be looking at is not just the level of spreads, but it's going to be the functioning of the primary markets. Are larger companies able to issue? Are they able to access markets? And the answer for the most part is yes for investment grade. It's also a yes for most up until a couple of weeks back for the loan market as well. I think high yield, lower quality companies, that's where there is a bit more of a question mark as to how much of it is about the borrower's unwillingness to tap into the market at these levels with the level of volatility that it is versus how many of them are going to be getting cut off. I think by and large, the thought process is that there is going to be much more constrained availability of credit. And to that extent, we need to worry about first-time, smaller debut issuers, lowest rungs within the high-yield market. Those are probably going to get cut off from the access to markets. And that's where you could potentially see that escalation where it's no longer about price, but it's about market access. And that probably gets the Fed to get thinking more.
Meghan, build on that if you can. Just lift the lid on the primary market in the way that Sri just did. Move away from the price of the story. Let's talk about supply, access to credit. Your thoughts?
Yeah, I think Sri is exactly right in a number of the comments he made there. I
think Meghan Graper's just frozen then. We're going to come back to her in about 2 minutes' time and finish that thought, I hope. Sri Sankaran, Jim Bianco and Meghan Graper sticking with us. Coming up next on the programme, the auction block, high-yield bond sales plunging this year. The lowest volume since 2009. We'll get the thoughts of Meghan Graper next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe with the busiest day of corporate bond sales since November 2020. Offerings from Unilever and Volvo helping weekly volume stretch above 28 billion euros. In the US, high-grade bond sales hitting 22 billion, falling short of estimates for a third consecutive week amid surging volatility. And finally, an issuer breaking through in the US junk bond market. Frontier Communications raising 1.2 billion in the first high-yield deal of the month. A little bit earlier, Mohammed Al-Arian weighing in on the current credit conditions. Take a listen.
It's an evolution from an inflation interest rate concern to a growth and credit concern. And that just tells you that the market is going sequentially through the risk factors. Keep an eye on it. Those of us who grew up in emerging economies have seen this movie before.
Back with us, Jim Bianco, Sri Sankaran. We have lost Meghan. Hopefully we can re-establish that connection in the next couple of minutes or so. Jim, I wanted to come to you on that. Access to credit, not the price of it. We saw that play out in 2018. We all remember that December where the high-yield market just completely froze up, the primary market. Sri thinks that's a good reference point. Jim, your thoughts on that?
No, I agree. It is a good reference point, and we've seen deals being pulled, but that's largely because of the macro considerations of volatility right now. Even at these levels, I think if the volatility settled down, you would probably get more deals done. But I think if you're talking about at what level will access really become an issue, I think it's going to be wider. So we're not, at that level. It's just the speed at which markets have moved over the last week and a half or so that has really caused people to sit back and pause.
I'm pleased to say that Meghan Graper of Barclays is back with us so she can finish that thought. Meghan, thank you for being patient with us. Let's just go back to what we were talking about. Let's get your thoughts, please, on supply, on access to credit.
Yeah. So on the supply front, I think what we're seeing are these more concentrated windows of opportunity, which have become the new norm. So, about half of April's supply came in a matter of 4 days. A third of March record issuance, that was upwards of a $228 billion month, that came in half of it came, or a third of it came in a single week. And so we're seeing efficiency of markets. But I think on the negative side of that, it does create these points of supply overhang where we're starting starting to see some disconnect between valuations in the primary and the secondary market. But as we think about depth of liquidity still available, it's an up in quality bid. It's certainly playing more defensively in the barbells of the curve. But I think from a supply vantage point, we've got 10 windows remaining between now and the Memorial Day holidays. We've got another 85 billion or so of IG supply to clear. And I think it will be selective windows of opportunity, but a functional backdrop for borrowers. So in terms of a liquidity crisis, a credit crisis, that's not where we are. This is fundamentally about macros. And I think that will be the influence on, what windows of opportunity we have in the days and weeks ahead. But issuers being very disciplined in the context of volatility.
Meghan, if that's true of IG, is it true of high yield? You mentioned where the bid is. The demand is coming from that up in quality demand. Where does that leave liquidity conditions further down in quality?
Yeah, I think that same flight to quality is happening in the high yield market as well. You look at what happened on CPI day, higher quality credits within that high yield subset of borrowers closed a half to a point better on the day with net buyers in the secondary market when the broader market closed down, 3/4 of a point. So there's a flight to quality and up in quality trade even within high yield. I think what you're likely to see is greater dispersion play out, greater selectivity, but I'm not worried about a closed market, particularly as we start to see the impact of spread widening on the ability for there to be renewed appetite for that asset class as well.
Sri, your take on liquidity right now?
I mean, this is the way to think about this would be that liquidity is going to be much more selective, right? I mean, part of the whole functioning of tighter financial conditions is going to be an allocation problem. It's not like we're not at a stage where it's broad-based drying up of liquidity. There is an element of allocation and where investors would want to prioritize, and it's very natural. So that's kind of why it is going to be, as that was being pointed out earlier, supply is probably going to be in concentrated windows. And at the same time, the appetite is also going to be relatively strong, we think, for some of the higher quality, more liquid portions of the market. And our simple advice to investors has been to move up in quality and stay liquid, because part of it is about the cost of funding. The other element of it is tighter access to liquidity, which effectively means that you want to be focusing on a simpler portfolio. So more complexity, more structured risk, more other forms of premium will start to go up. And that's kind of what the next leg of it. Eventually, it may kind of boil into something which has a stronger, more broad-based credit flavor. But I think we're still some way away from that.
Well, that's where we are at the moment, thinking about the worries of the future. Jim, do you see anything developing here that could take down this cycle?
Take down this cycle in what respect?
Some risk in the financial markets that ultimately takes down the economy. You know that story, that markets can shape the events they anticipate, that it's the tightening of financial conditions, the risk in credit that ultimately takes down the cycle.
Oh, yeah, there's definitely risks. And I think the biggest risk is the Federal Reserve itself, with a one-sided view of the world as inflation and not being concerned with what we've seen now. Look, if you look at most of the broad risk measures in the market, they're worse now than they were in 2018 and 2013. 2018, we got the Powell pivot. 2013, we've got the taper tantrum. And yet we've got pretty much worse measures now, and we've got promises of tightening financial condition and 50 basis points at least for the next two meetings, if not even more aggressive than that. So, yeah, there is definitely that view that the Fed will keep hiking until they break something. And if I was to update that, it'd be the Fed will keep hiking until they break more things, because they've already broken some things, and I don't think they're ready to stop because their focus is inflation. It's not growth. It's not liquidity. It's not financial markets right now. It's inflation.
Jim, what do you think they have broken already?
Oh, I think if you look at the yen and in the currency markets, that's under stress. I think that the commodity markets, oil trading is, quite frankly, it's dysfunctional, and it has been for a while. If you look at low-rated credit, we've been talking about everybody moving to high-rated credit. Look at the spreads between high and low-rated credit. Those things are not really performing well. And the stock market itself, I mean, has it moved 1% since this show started? It seems like it does that a couple of times a day. And so those are signs that things are broken, but it's not broken enough to get the Fed off of their
zeal to bring in inflation.
This market is aging me, I can tell you that. I said to my producer before the show started, when do you think the inflation print was? And he said 2 weeks ago. And of course it was 2 days ago, but it feels like 2 weeks ago, maybe even a month ago. Sri, when do you think all these things that we're starting to talk about, we're starting to see in this market in more pronounced ways, shows up in the economic data? For how much longer do we need to wait to see that?
I mean, I would think that it probably starts showing up in market pricing and the fundamentals of the corporate balance sheets before it actually starts showing up in the broader economic data, right? So one of the tension points this time around has been how healthy corporate balance sheets have been, which kind of speaks to the point that Jim was making earlier, the ability of companies to digest higher interest rates. That's definitely better now. But at the same time, there is going to be a pocket of the credit market, the lower quality, floating rate oriented liabilities, where you would see that ratcheting up of funding costs go up naturally. They don't need to refinance. The in-place cost of funding will start going up, and that will create more tensions, and you will see more kind of earnings misses or weaker guidance being penalized stronger for these kind of companies. We've already seen that in the last 1 week. I do think that there's more of that to go. So decompression and dispersion would be the first indication that we are seeing more cracks showing up in the credit market first before the broader economy comes through, and we haven't seen enough of that.
Sri Sankaran, Jim Bianco, Meghan Graper, sticking with us. Up next on the programme, still ahead, the final spread, the week ahead, featuring US retail sales and another busy slate of Fed speak. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. Here is your week ahead. Coming up over the next week or so, a ton of Fed speak, including Williams, Mester, Bullard, Evans and Chair Powell speaking through the week. G7 finance ministers and central bankers meeting in Germany on Wednesday. Initial jobless claims on Thursday. And you get US retail sales coming up a little bit earlier in the week as well. Let's get to the rapid fire round. 3 quick questions, 3 quick answers. Here's your first one. Where does headline CPI finish this year? Pick a number. Jim Bianco.
Above 4%.
Sri.
5.
Meghan.
Low 4s.
Where does Fed funds peak this cycle? Pick a number. Meghan.
Oh, target or terminal?
End rate for the Fed funds.
End rate. Low 3s.
Jim.
I'll agree. Low 3s.
Sri.
3.5.
Have we seen the high on the 10-year yield for the year? Just a quick yes or no. Sri.
No.
Meghan.
No.
Jim.
Clean sweep. No.
There we go. From New York City. Thank you, guys. This was Bloomberg Real Yield. This is Bloomberg TV.